morning, everyone. Thank you for joining us today, this Thursday morning for the webinar with Generation Mining. The company is developing the largest undeveloped palladium project in North America. My name is Adina. I'm head of business development in Emerging Markets Capital that is hosting today's webinar. So Emerging Markets Capital is a private mining investment firm based in Hong Kong, and we help Canadian mining companies to build strategic relationships with investors in APAC region. So just to remind you that today's webinar is for informational purposes only. And a short, brief introduction about Generation Mining that is presenting today. So the company is developing the Marathon project, which is the largest undeveloped palladium project in North America. Last year in 2020, company delivered the preliminary economic assessment, and it is expected that the feasibility study will be communicated shortly in this quarter 2021. Kerry Knoll, executive chairman and director at Generation Mining. He has over 35 years of experience. He successfully co-founded several mining companies, including Wheaton River, Thompson Creek, and Glencairn Gold. He is also a former editor of the Northern Miner magazine.
So yeah, the company Generation Mining is focused on mainly three metals. We've got 5 metals that we can produce, but the main one being the palladium. And of course, palladium, I think you probably all know, is used to scrub emissions from exhaust pipes. And especially in the last couple of years and in the next couple of years going forward, both Europe and China have had stricter emissions rules. And because of that, each car needs a little bit more palladium, and that has put the whole market into shortage. And there's no other mines slated to come on over the next couple of years, so the shortage is expected to continue for the foreseeable future. We also are going to be a significant copper producer. We have more than 1 billion pounds of copper in our resource, and we also have 1 million ounces of platinum. And of course, platinum is going to be a real important factor in the rollout of the hydrogen fuel economy. So we've got kind of the metals that we, there's other metals, of course, that are involved, lithium and nickel and cobalt, but these are 3 key metals. And one of the important things is that palladium is not a metal of the future. So it's not like, if electric cars get popular by this year or that year, that, nickel will be in demand. Palladium is in demand now, and it's in a shortage now. And it's used to clean the air, especially one of the greenhouse gases it's cleaning is nitrous oxide, which is 300 times more potent than carbon dioxide in a greenhouse gas. So our company is a PGM developer. We own 80% of the largest palladium property in North America. The other 20% is owned by Sibanye, which is one of the largest PGM producers in the world. We did a study last year, and it showed that this project had a net present value at $1,900 palladium of $1.5 billion Canadian dollars. That's about 1.1 billion US dollars. And that, if you look at today's price, it's about $2,400 an ounce. That number would be well over $2 billion. So that prompted us to do a feasibility study, which we started in March last year, and we're expecting that to be out in the next probably in the next week. So you can look forward to that. And we're pretty happy with the way it's been going. We have a total of 8.6 million ounces, which if you look at our market cap of, I don't know what it is, $125 million Canadian. So about $90 million US. I mean, we're trading at $10 an ounce in the ground, which is low for somebody who's at the feasibility stage. And why is that? Well, part of the reason is because we don't have a feasibility study yet. And I think part of it is also because the world is not really focused on palladium. There's not a lot of good palladium stories out there. And we're the only one really in a region where it's considered a tier 1 region. We're also not just in Canada. We're we're surrounded by infrastructure. We've got rail, we've got airport, we've got a town right nearby, so we don't have to build all that infrastructure. That's usually one of the biggest costs of building a new mine, is all the infrastructure, the road in, the power lines, the generators. We don't have to do any of that. And we're sitting on about 13 million in cash, probably down to about 12 million in cash right now. And that's the breakdown of our metals. I think I've hinted at this before, and so I won't dwell on that. So myself, I've been in the mining business now for about 40 years, and I've started 6 mining companies from scratch. And of those 6 mining companies, 4 of them got into production, and the other 2 got sold at the feasibility stage. Jamie Levy, the president and CEO, we've been working together for about 8 years. We had a company together called Pine Point Mines previous to this, which was bought by Osisko Metals in 2018. Drew Anwell, our chief operating officer, was one of the key guys behind Detour Gold. You guys may recall Detour was sold to Kirkland Gold for about 5 billion Canadian dollars, and he was one of the founders of that company. I won't get into all the different people. And then we've got a very, very strong board of directors. Steve Reeford's a geophysicist. Jennifer Wagner is Kirkland Lake. She's a lawyer who works for Kirkland Lake Gold. She's their senior vice president. Phil Walford is was the founder of Marathon Gold. You might have followed that one, the Valentine gold discovery out in Newfoundland. Cashel Meagher is chief operating officer of Hudbay, and Paul Murphy is an accountant and is the chairman of Alamos, and was the head of the mining group for PricewaterhouseCoopers in the Western Hemisphere. Also have a guy named Steve Haggerty working with us. Steve was a vice president of Barrick. He's also metallurgist by trade, and has redone our flow sheet at our mine, and just made our recoveries better and our mine better altogether. So here's Lake Superior, northwestern Ontario. There's the town of Marathon right here, and we are just outside the town of Marathon. And the big Hemlo mine that's produced 25 million ounces is just down the road. Alamos has their Island mine here. Magino is building the Argonaut's building the Magino mine here. Hard Rock is going into production. That's a joint venture with Orion and Equinox. And this is the only operating palladium mine in Canada. It's a similar geology to our geology, and it's owned by the South African firm Impala, who bought it for $1 billion. And it's a smaller mine than ours, and it only had a 7-year mine life when they bought it for $1 billion at lower than today's palladium prices. So I think we're going to be worth quite a bit of a premium to that once we're built and in production. I was talking before about infrastructure. So I'll just point out a few things. This is the Trans-Canada Highway. Goes right through the property. There's the airport, CPR main rail line. And this power line right here is under construction right now. And it's bringing nuclear energy to this part of the world. So it's carbon-free electricity that we'll be using at the mine. And we'll be able to this is an existing power line here, and we're going to be able to tie off of this. So this is a 230 kilovolt power line that the government is building at a cost of $1 billion. The timing for us is just fabulous, because all these other mines in this area, they have to put in generators, and they have to generate their own power with either diesel or natural gas, and it's a lot more expensive, and it of course produces a lot more carbon. And then the town of Marathon itself used to be a pulp and paper town, and then it was supplying the Hemlo mines workforce, and now now the town is slowly fading away, but our mine is going to revitalize the whole town. So there have been 3 feasibility studies done on this project before, but when they looked at it before, they were looking at it as a copper mine, and it's got a lot of copper. But now the palladium price has changed all that, and palladium is about 58% of the revenue, as compared to 26% for copper. So it's but we did have the advantage of these 3 studies that were done previously when we looked at buying it, and also in order to plan our own feasibility study. A lot of really good work had been done, which is why we've been able to do our feasibility study for a lot less money than normal. Stillwater owned this project from 2010 to 2017. And they were actually, they put it on care and maintenance. The palladium price in 2016, I think, was around $600 an ounce. And Sibanye acquired them in 2017 because of their mine in Montana. And we then approached Sibanye and were able to buy this project from Sibanye. So we have now increased our interest to 80%, with Sibanye holding 20%. Sibanye does have a back-end right. They can pay $133 million based on the PEA numbers and buy back 31%. We don't think they would do that. We think that if they wanted to build this mine, they would just buy us, but we can't say what they're planning to do at this point. But they do have that back-end right. We would be very happy if they would back in, because our share of building the mine would go down to $145 million. And that is going to be all debt, because they would have to put up enough of the equity that we would probably be carried all the way through to a 49% interest in the mine. We wouldn't have to dilute anymore. And this mine, I think, would be worth multi-billion dollars. So I would love to own 49% of that and not have to sell any more equity to do it. So I'll talk a little bit about our PEA, and again, these numbers will be out of date shortly when we release our feasibility study. We just wanted to get in front of you guys before the feasibility study comes out, because we think we are going to get re-rated when that happens. But the PEA looked at almost 200,000 ounces a year for an upfront capital of 431 million Canadian dollars. That's about 310 million US dollars. And that showed a net present value of $871 million, and that's at $1,275 palladium. Bear in mind, palladium is now at $2,400 an ounce. Even at $1,900 an ounce, this has a $1.5 billion net present value, which is more than 3 times the capex, and you don't see that in mining very often. And at today's price, that would be that $1.5 billion would be well over $2 billion. And we're going to be able to produce palladium in the PEA numbers for about $500 an ounce. It'll be probably slightly higher in the feasibility study, but not meaningfully so. And this is the life of mine: 89 million tons, 14-year mine life. 3-to-1 strip ratio, and about 1.25 grams. So the net smelter return on a ton of ore coming out of this mine is going to be about $70 if you do the math on it. If you look at the cost of mining and processing a ton of rock, it's about $20. So if you can pay $20 and get $70 back, that's a really, really phenomenal rate of return, and that's what we're going to be seeing. You know, this copper grade here is about the same grade of many copper mines around the world. And copper is only 26% of our revenue. Most of the revenue is coming from palladium. Another nice thing about it is the payback periods, depending on the price. If you look at $1,900 palladium, 1.5 years. Banks love a 1.5 year payback. The only other junior mining company, which is Platinum Group Metals, which has a really good looking deposit in South Africa, their payback period is 8 years, which of course banks don't like as much, because a lot can happen in 8 years. So one of the things we're doing is we're looking at the possibility of locking in higher palladium prices with end users before we start building, because if it's still up around $2,400 and we can have a year of $2,400 palladium, we'll get most of our money back out in that year. And for the end users, they have the advantage of locking in a price, because they might fear that palladium would go up even further. There's also no royalties on this project. So I'm sure you guys have heard of the streaming companies out there. Well, the streaming companies are all circling. They want to look at this thing. They because we could do a stream on our gold and silver and platinum and keep the copper and palladium for ourselves as one option. The whole point is that there are no royalties on here, so we could finance a significant part of the capex just through selling some royalties on some of the lesser metals in here. And I don't know if you guys follow rhodium at all. Rhodium's trading at $24,000 an ounce, and that's about $700 US a gram. Well, we have about a gram of palladium in our concentrate that we're going to be selling. And traditionally, the smelters don't pay you for the rhodium, but they're starting to. And one of the proposals we have from one of the smelters, they're actually offering to pay us for 50% of the rhodium, which would change our economics dramatically. Unfortunately, we we don't have assays for the rhodium in the resource because or in the reserves because this project was never assayed. We just know that it reports to the concentrate, so the copper concentrate. So the rhodium is recoverable, but it's in very small amounts. But it's still it costs us about $250 to transport and treat a ton of concentrate. Well, we've got $600 worth of or $700 worth of rhodium in there. That'll pay for it. Even if we get paid for just half of it, that'll pay for all of it, all of those costs. I don't know how familiar you folks are with the engineering firms in Canada, but G Mining is probably the premier open pit mining specialist in Canada. They did the big Malartic mine for Osisko. They did the Fruta del Norte mine in Ecuador for Lundin Gold. They did the big expansion of Detour Gold. They built 4 mines for Newmont. And so this is actually a small mine compared to a lot of what they've done. So they've overseen the whole feasibility study, and they've also done the mine design and the reserves and the site infrastructure. They don't do plants, so we've hired Ausenco Canada. Ausenco is a worldwide firm, and they've finished their work now. Knight Peacehold, another international firm, did our tailings for us. So those are the big 3. And I think I hinted at it. So our PEA was looking at 5 million tons a year. We're actually jumping all the way up to 9.2 million tons a year in our feasibility study. So it's going to be a lot bigger mine. We're adding tons to the reserves as well. And one of the things we've done is reschedule the mining plan so that we mine the richest palladium ore in the first 5 years, and then we switch to the richest copper ore for the back 5 years. And the reason for that is we anticipate that the next 5 to say 8 years is going to be very strong for palladium because there's not much new capacity coming on. And countries, India, Brazil, even Nigeria and Malaysia and Indonesia are all looking at increasing the amount of palladium that each car needs to clean up the air in their capital cities. And that's going to need a lot more palladium. And also people are switching to hybrid cars, and hybrids need more palladium. So we think we've got a good eight years here in the palladium market. And then at that time, if electric cars are getting more popular, which we think we will, we'll be switching to our more copper rich ore, which is in one of the pits. Recoveries, we've increased the recoveries by 4% over the PEA. This is for our feasibility study. We've increased copper by 3%, and we've increased platinum by 10%. And all of this extra metal comes at no extra charge. So we're really excited about this and what those are doing to our numbers in our feasibility study. So this is what the mine's going to look like from the air. There's the little power line. That's all the power line we got to build. And we only got to build 4 kilometers of road. So there's not a lot of infrastructure going into this thing. These are the 3 pits we've got. The north pit is the one that's rich in copper. So we're going to be starting to mine in the south and the center, and then move our way north as the price that we anticipate the price of copper to get very, very strong as the electric cars roll out. I don't know if you're aware, but an electric car uses 4.5 times as much copper as a regular automobile, and there's very little new copper capacity coming on in the world. So where that copper is going to come from, it's the big secret for all this green economy of the electric cars is there's just not enough nickel, there's not enough copper, there's not enough platinum. They're just, all these metals are in shortage. A typical automobile today, a gas car, uses about 5 or 6 grams of palladium, and that's up from 2 or 3 grams only about 10 years ago. And that's because the more you use, the more it converts, and it converts 98% of the carbon monoxide and the nitrous oxide into things that we can breathe. And I think you all realize the palladium loads are increasing in China. They're increasing in Europe. India is talking about it. Brazil's talking about it. They haven't done it yet, but their capital cities, their big cities, Sao Paulo, in a bunch of cities in India are just horribly, horribly polluted. And so they've got to deal with these gases. The annual demand in the world is only about 11 million ounces, and the mine supply is only 7. So some of it comes from recycling, but there's also a shortage, and we expect that shortage to continue. And here's what it looked like. It was in surplus here because it was mined as byproduct from platinum mines. This is from 2000 to 2010. And a lot of this was stockpiled. The Russian government was just buying it all up, and then the Russian government sold it into these years to make up for the deficits. And now this stuff is all gone. Like all the stockpiles are gone, and yet we're still looking at deficits going forward. So that's why you've seen the price move up like this. And as I think I mentioned, hybrids are more popular than electric cars by a long shot, and of course hybrids need more palladium than even a regular gas car because they don't burn as hot. And these things, these catalytic converters don't start converting the gases until they get hot. This is a guy named Matt Watson, who's a consultant to the car companies out of California, and the feedback that he's getting from their projections are that hybrids are going to be continuing to be more popular for the foreseeable future than electric cars. I don't know if this is right. This is his, but nevertheless, he sees an increase in demand for palladium over the next couple of years, rather than we're seeing it remain flat, but still in deficit. So that's just in that one man's opinion. And of course, here's this take on copper, is that we're looking at a huge deficit in the next few years in copper, and that's just with consumption going up the same curve that it's been going up for years and years and years. The problem is that mines are closing; they're running out, and there's no new mines being built. There's been very little exploration. There are a couple of new mines being built, but they're not very common. So valuation, well, this is the price to the net present value. We are trading at about 0.2 times our net present value in our PEA, and that's for our 80% of the mine. The average up here, you got these big guys over here, but even of the middle tier here, the average is 0.7, 0.8 of NAV. So we've got a long way to go up in terms of share price just to get to the middle of the pack here. And a lot of these companies don't even have feasibility studies. Some of them do. And there is one platinum company in there. The only other platinum junior company in the world is called Platinum Group Metals. And they're trading at almost 3 times the multiple that we're trading at. And we think it's because they have a feasibility study in hand, whereas we don't. So we have a PEA. PEAs are preliminary. That's by definition. So we think that we're going to get re-rated somewhere here. And this is us. This is a comparison between 3 mines. Ivanhoe's building a Platreef mine. This is the Platinum Group Metals, and this is us. And just if you cherry pick a couple of numbers here, we've got a much higher IRR, and we're using it at a lower palladium price than they are, and yet our IRR is higher. Our net present value is higher than theirs. Our payback period is much shorter. Ours is 2.5 years, and at today's price, it's less than 1.5 years. They're looking at 8 years payback. So there's a lot of advantages we have over them. Yet they have a enterprise value of $446 million, and we're higher than this now. Our share price has gone up since this chart was made, but nevertheless, we are well valued below them. And they have a really they do have a really great deposit. It's just that they have a long payback period. This is the famous lasagne curve. So this is what happens when a new mine is discovered. Everybody gets exciting. The stock price goes up, and then they have to pause it all and start doing the work, and the feasibility study, and the permitting, and all that boring stuff. And people head for the doors, and the share price usually comes back down. And then when they get finished the feasibility study and they get finished the permitting, that tends to start going back up. The institutions are usually the first to get in, and then retail, and then you've got an operating mine. So we've only had this project for 19 months, and we've accomplished a lot. We first of all, we bought it, but then we got the resource done, updated. We got a PEA done, We got a new listing on the Toronto Stock Exchange. There's only 2 palladium companies on the Toronto Stock Exchange. We got a feasibility study that's almost finished, and we're halfway through our permitting. And we anticipate that sometime about 12 to 15 months from now, we'll have our permits in hand. Rest of this year, we're going to be spending doing the detailed engineering. Some of the companies wait until after their permits because of the risk. We don't see any risk in this. So we want to do this simultaneously to this. That's about a $15 million ticket. And then we're also going to use the remainder of this year to arrange the mine financing to build the mine. We're also going to be buying some of the long lead time items like the ball mills. We'll order those. And then we're hoping to begin construction sometime in the second quarter of 2023. And it's about a 20-month construction period. So that's the story. We are anticipating being very close to production by the end of 2023. And this is just to show you what's going on in the mining scene in Canada. It wasn't always this way. This is the premier of the province we're in, Doug Ford, and this is the Canadian Prime Minister, Justin Trudeau. And they are here at a groundbreaking ceremony at a new gold mine about 100 kilometers from ours called Cote, which is being built by IAM Gold. So just the fact that they both showed up at this, they don't show up at things that they're not in favor of. So this just shows that we have a government in this country. For the first time in a long while, the provincial government and the federal government are both pro-mining. So just to wrap things up, we've got about 136 million shares outstanding. Back when we were around 85 cents, and this is Canadian dollars, $115 million market cap. So based on our net present value, it's quite a low price. But we have had a good year. I mean, it's gone. The share price has gone up steadily through the year, and it's more than double it was at the start. Some of our big shareholders are big names in the mining business. Eric Sprott and Lucas Lundin are both billionaires from mining. Sibanye is the largest platinum producer in the world, second largest palladium producer. Osisko Mining, a very successful mining company, a development gold company. They've been participating in our financings. They were up at about 10% at one time. They've taken some of their profits. They made a lot of money. They tripled their money on our shares. And the directors and officers have participated in every financing. There was no founder stock in this company. We all paid the same as everyone else by participating in each financing as it went through. And that's the end of the presentation. I am just going to talk a little bit about this rock. This rock was found on the property along with some others, and it was one of the richest palladium samples ever found, 188 grams per ton and 9% copper. We know this did not come from our deposit, so we're looking for the source of it, and we're drilling right now. The model is that here's the main zone. This is a magma chamber, so this is lava coming up from the deep in the earth, and as it comes up, if there's cracks, caverns, underground caverns, they can fill up with material, and this is what we're looking at mining here. But sometimes along the way up, you get another big crack, and over time, this gets filled up with the heavy metals, and they get stuck down here. It's called a sulfide pool. It's a very common thing in geology. The famous Voisey's Bay ovoid was a sulfide pool. So we're thinking that this rock was formed in one of these pools down here and carried up with the magma in a subsequent event, and therefore we're looking for it. We're looking for that. And here's a more not theoretical diagram. This is the open pit that we're going to be mining. This is the drilling in the open pit. So we're now drilling down the conduit. Right now we're drilling here. We'll be drilling through the year. We're trying to find that sulfide pool, and we've already found some pretty rich material in here. If you look at some of these grades, they're more than two to 5 times what we're mining in the open pit. So even if we don't find that sulfide pool, it looks like we're starting to develop a future underground deposit. It won't be part of our feasibility study, but that this future underground deposit could extend the mine life significantly. So that's the story. I think we can open it up to questions now.
The first question is, once you have your feasibility study, is your thinking that you're share price will trade closer or even a premium of NAV. Is this typically validated by analyst coverage from banks? And then do you have coverage from banks currently? And if not, do you have a plan to increase coverage?
Coverage is difficult to come by because there's 1,500 junior mining companies in this world, and
yes,
the analysts can only cover so many. But that said, going back, I think that we're expecting to get re-rated. I don't know that we'll make it over NAV, but I think that 50% of NAV would be an almost tripling of our share price, and that's kind of our near-term goal. And we're going to be marketing. We're giving a lot of presentations in March and April. Like we're presenting to literally more than 1,000 people during that time. So part of it at conferences and things, virtual conferences. We do have 2 analyst coverage. 2 Canadian banks are covering us currently. One of them has a target of $1.30 a share. I think that one is a little bit misguided because it has a much higher capex than our estimate than what our capex is going to be. So I don't know why they did that, but they only think it's $1.30, which is still nevertheless about a 40 or 45% improvement over today's share price. The other analyst who seems to be a little more accurate on terms of what we're going to our feasibility study is going to look like, he has us slated for $1.75, and both of those only came out within the last month. So we're going to be working on others. We're now talking to the bigger banks. We're presenting to banks like TD and Bank of Montreal, BMO, and possibly some of the other ones as well. But those 2 have already been lined up. So we are stepping up a notch in terms of who's at least talking to us. They all see the possibility here of debt and equity requirements that we're going to have, and they want to get involved.
Fantastic. So the next question is, what value of the mine comes from palladium versus copper and other metals using current prices?
So I'll speak for the feasibility study, but the numbers are very close to the PEA.
Yeah,
I was just reviewing the feasibility studies today. So feasibility study at the price we're using, which is $1,700 palladium and $3.20 copper. So at those numbers, the mine is 58% of the revenue comes from palladium, 26% comes from copper, and the rest comes from, in the declining numbers, from platinum, then gold, then silver.
Right. So yeah, so that makes sense what you mentioned before about your sequencing.
Yes.
Yes. And the other question that we had was related to the rock specimen that you showed. Can you just expand a little more on what that potential origin could mean? And are you currently allocating a budget for exploring that possibility? And if so, how much, or what percentage of your exploration budget?
Right. So that rock, first of all, it came from somewhere, and the place where it came from may not exist anymore. But if it does exist, I think we're going to find it at some point. So what we're doing is we're thinking that it had to come what's called a conduit. So I'll just go back to that diagram. So this here is the conduit. So this is the lava coming up on its way to surface, and right now the surface is here. But back a billion years ago when this was being formed, the surface was somewhat higher. But it would have been happening during a volcanic eruption. And as the magma comes up, if you get underground caverns, which are quite common in our world, the magma will then filter out into these caverns and fill them up. And that's where you get a deposit. And literally what happens is that the heavier metals, so the platinum, the palladium, the copper, they tend to precipitate out into this because of gravity. But we're thinking somewhere down below, there was an even richer pool. And I can give you an example of one in real life that's not too far from us. And that is this one here. That's the Eagle deposit, which is right across Lake Superior from us. And that's exactly what happened here. So this was the magma chamber, the magma coming up, and it got deposited here. And this is the Eagle nickel mine that is owned by Lundin Mining across the lake from us. So we're looking for, and we have a geophysical outline of this, which looks exactly like theirs. So this is another place we're going to be drilling. So we're planning 8,000 meters of drilling this year. That's probably 15, 16, 17 drill holes at a cost of about $2 million. That's our budget on the exploration side.
Right.
Not a big one.
Fantastic.
The problem is none of the exploration we're doing, none of this can be included in any discovery can't be included in the feasibility study.
Yeah.
So it's only for future value.
Yeah. Yeah. Well, excellent. Well, those are all the questions we have. It was great to have the opportunity to speak with you. Really a very unique company, and grateful that we have the opportunity to learn more about it. Also, I think a lot of us always following palladium, but it's one of those commodities that we understand the commodity, but not, as you mentioned in your presentation, not too many ways to have access to it in the public markets. So thank you very much.
I'd encourage everyone to go onto our website and sign up there as well, because we'll be doing another webinar on the feasibility study numbers in the next week or 10 days or whenever it comes out. And of course, that will be in the morning our time, so in the evening your time. But it would be it'll also be archived, and you can watch it the next day.
Excellent, excellent.
Yeah.
Thank you very much, and have a good evening and good rest of the day to everybody here in Asia.
All right. Well, thanks, George. Thanks, Adina.